Okay, let's call the meeting to order. Um, let's get a roll call. See who's here right now. Michelle, you're here.
George is here.
George.
James is here. He's muted, but he's here.
Okay, good. So we have everyone. We have everyone here.
We have a quorum.
Okay, we have a forum. Okay, good. So I don't think we're going to be standing up to salute the flag today. Do we need to do that on the flag or not?
We have been.
You have been?
Mm-hmm.
Okay, so do we have a picture of the flag or not? Let's just stand up and do it.
Yeah, you could do it without the flag. That's
You can do it, okay.
Oh, there we go.
There we go.
All right, we got it.
Pledge allegiance to the flag of the United
States of America
and to the republic
for which it stands,
one nation, under God, indivisible, with liberty and justice for all.
Okay. Now, the next thing on the agenda is the public input. Is there any public input at this point?
Nobody here.
Okay, so we'll go on to the next subject, which is, excuse me, my voice is a little cracking. Approval of minutes from the regular meeting of July 15th. Does everyone have the minutes in front of them?
Yes.
Yes,
okay. Do we have any input or any objections or?
Motion to accept meeting minutes.
Okay, do I have a second?
Second.
Okay, all in favor?
Aye.
Aye.
Oh, any opposed?
Yep.
All righty. So let's go to the next subject matter, and that's our fiscal year 2019-20 pension valuations. We'll start with the actuarial report.
I'm going to share my screen. Oh, the host needs to enable my screen sharing.
Okay.
Host, where'd the host go?
Nope, I'm working on it.
Thank you. Should have tested that while we were gathering.
That's okay. I'm sorry. Which one is it that you need, Michelle?
I just need you to give me permission to share screen, actually, not for you to share your screen.
Oh, okay. Let me see here.
So you can stop sharing your screen.
Yep, that's what I'm gonna do.
And then on the bottom where it says share screen, there should be a little arrow where you can change options.
Yep. There we go. You should have it now.
All right, perfect.
Okay.
All right. Hopefully everyone can see my screen now.
Yes.
Yeah, we can see it.
Wonderful. This is the same material that was shared in advance. We're just going to walk through it on screen. I'm going to start with the police department, and then we'll move over to the town side plan. The material is going to be very similar between both the police and the town. I just like to walk through each separately because they have slightly different stories going on. Starting with the police plan, this is your open pension plan. What that means is as active police officers are hired, they enter the pension plan and they are allowed to accrue benefits and they pay contributions. So what you'll notice, and historically has been the case, your active population stays very, very stable. It's been at 36 or 35 for the last 4 years. This is what we expect because when somebody terminates or retires, you hire another officer to replace that officer. And so active population stays stable. Your inactive population, meaning people who were police officers actively employed by the town, but are now either terminated, due a benefit in the future, or retired and currently receiving a benefit today. This past year was unique in that you see a significant increase in your active population. You had 1 employee retire, and you actually had 4 new employees join the pension plan. So what happens when we actually start seeing a little bit of growth in the population, that's going to translate over to an increase in your normal cost and your liabilities, because we expect that to be stable over time, but this is an unexpected increase. One other increase that you're going to see when we look at your liabilities is that the officer who retired was offered, everyone was offered, but this specific officer accepted the opportunity to receive an additional few years of service in order to retire when he did. This small decrease in your terminated members from 2 to 1, that's somebody who was owed a return of their employee contributions. He did not complete enough years of service to be vested in a pension benefit, and so he just elected to receive a return of contributions. This 1 remaining terminated member is the same situation, contributed to the plan, has not received those contributions yet, is not vested in a pension benefit. And I should mention at the beginning, please do interrupt, ask any questions, especially as Ken is getting familiar with everything. Please do ask questions if something comes up. But let's dive a little bit deeper into your active population. This table shows how your active population is distributed, looking at by age bucket and by years of service. And we like looking at your population in this manner because then we can help to predict what might happen in the near future. When you see a concentration of people in the older ages and higher years of service, then we anticipate more retirees in the near future. When it's a relatively younger population, as your population is, then we don't expect to see a lot of turnover in the near future. We expect them to continue accruing benefits and they'll retire as they get farther along. One thing we can look at here too is how many people do we expect to retire in the next year? And the normal retirement date for your police officers is age 55 with 10 years of service or 25 years of service. And so we can see very quickly that there is nobody with 25 years or more of service currently. So we don't expect a significant amount of normal retirees in the near future. Scrolling down, this is a quick summary of your retiree population. So you have 16 retirees. They are currently receiving pension benefits and 3 beneficiaries. These are people whose spouse was employed by the town as a police officer and that spouse passed away and now their beneficiary is receiving their pension benefit. And you can see on average, your retirees are receiving $40,000 a year and your beneficiaries are receiving $29,000.
Do what?
Take a screenshot.
I don't know.
No.
The next component to look at is your assets. So how have your assets performed in the last few years? Not unexpected, the last year was a little bit rough on your assets. Remember, we are measuring all of this information as of July 1st. And so you should actually be grateful we're looking at it as of July 1st and not say March 31st. Not sure if everyone remembers what March 31st looked like, but I think Halloween was similarly rough. And so we're looking at it at a snapshot in time. How did the assets perform? And you can see when you snapshot look at things, your assets are going up and down and up and down. This is what the market does. And so what we actually use for your funding valuation is a smoothed value of assets or an actuarial value of assets. So what that does, it takes all of these gains and losses and spreads them out over a 5-year period. So you're not reflecting all of this negative 1.27% return, all of this 0.24% return, or all of this 10.33% return. It smooths it out over time. And this helps for budgeting purposes. So you're not going to experience those giant market swings. And this is especially good when you're looking at a pension plan. It's a long-term liability. You want to spread these out over time and not be susceptible to these market swings. And so when we scroll down, that's what these 2 bars are looking at. The darker bar is the market value of assets. That's the exact snapshot in time. and the lighter bar is your actuarial value. You can see that the actuarial value is a little bit more stable over time. Sometimes it's a little bit higher than the market value, a little bit lower. It's smoothing out your results. And so right now, because there is an accumulation of past losses, your actuarial value of assets is higher than your current market value of assets. What that means is over the next few years, if there aren't additional gains in the assets to offset those losses, it's going to put more pressure on your contribution because you're going to be recognizing those losses over the next few years.
Or you have to increase the contribution, is that correct?
Correct. Yes. Your assets will grow in one of two ways, either good market performance or contributions.
Right.
So when we talk about return, it's not just that exact rate of return that happens in the market. What we care about is excess return or less than that expected return performance. And so we have to formulate what your expected long-term rate of return on assets is. And we do that by looking at your target asset allocation. We come up with what we expect your rate of return to be over time. And this is, again, a long-term perspective. And this is where I would typically, if we were all sitting in the same room, look at Mike Fort and say, this is his area of expertise. And he does assist you with formulating the target asset allocation and making sure that we're on track with the expected rate of return. We as actuaries take that information and use it.
Now, what's our actuarial rate of return average? What are we doing right now?
Your current assumption is 6.675%.
Okay. Now, how does that stack up to other towns? Is that still pretty reasonable?
It is still pretty reasonable. And so what you want to look at, I mean, we all always compare to our neighbors. We can't help it. Like, that's just what you do. You say, hey, what's that guy over there doing? But what you want to look at is how are you invested and how does your population behave? So some communities are fully frozen. They don't have anyone accruing benefits, or they're predominantly retired. And in that case, you want to be more risk averse, less risky assets. And so you're going to be more conservative. And instead of having, say, 40% in fixed income, you might be more like 50% or 60%. And that community, we would expect to have a lower rate of return because they have a shorter time horizon that they're going to need to pay off those benefits. With an open pension plan, you can afford a little bit more risk, which gives you a little bit more of an expected rate of return. Overall, I would say most are working to get to 7%, and you are already below 7%. So you're ahead of the curve in that respect.
Good. And our long range projection for return is somewhere close to that, 6 3/4, 7.
So it depends. And that's what this bottom chart is looking at. How do we expect the rates of return to occur over time? And when we look over the longer time horizon, getting out towards 75 years, which is what we expect your long-term horizon to be, the mid-range, the 50% median is 6.24%. But this is not reflecting the fact that you do have active management involved. And so the industry term that a lot of people don't actually like to use anymore is alpha, because there's a lot of argument over if it's alpha or beta. But you can expect that you should slightly outperform the expected market return because of the fact that you have a manager assisting you in these asset allocations. And so 6.24% is probably on the conservative end, but it is certainly something to keep an eye on, that as assets are not performing the way they used to back in the 80s and 90s, that's why you took the step last year to move down from 6.75 to 6.675. And it's something to keep in mind as we look at it year over year. If there's an opportunity to take a little bit more risk off the table, be a little bit more conservative in the assumption, then that's good. However, important to keep in mind is that the town has been actively contributing in excess of the minimum required contribution. Right. And so there is a balancing act where you are already contributing in excess. And so you are outperforming because of those additional contributions.
Good. So that'll eventually build up on the next chart, our funding ratio. That'll help it in the future.
Yes. So we will look at the next chart. So now we look at your liabilities. And we do expect your liability to grow over time in general, because your active employees are accruing an additional year of benefits, additional year of service, and your liability reduces slightly as benefit payments are paid out. But then we roll that all forward with 1 year of interest because of the time value of money. So overall, we do expect a relative growth in your liability from year to year because of the active population and just as it accumulates. It did go up more than we expected. And that's because, again, you had the additional active employees who joined the plan and also that one retiree who received an additional few years of service as he retired. You also, on the police side, you have a relatively younger retiree population. And so we do not see a lot of deaths. And in the actuarial world, no deaths means losses, unfortunately, for the pension plan. Because if they don't die, then they continue to receive pension benefits, higher liabilities. Moving down, we can look at how your liability breaks out between members in pay status and active members. You can see it's growing in both populations. And we generally look at your unfunded accrued liability. This is the difference between your accrued liability and your actuarial value of assets. This is an accumulation of changes in assumption, poor experience, all of those come together to form an unfunded accrued liability. You then pay that amount off over time by amortizing it into a past service cost. So you get to the bottom line and your funded ratio stayed stable from last year to this year at 74.3%, which especially for a police plan, that is a commendable funded ratio compared to most populations. This translates into your actuarially determined contribution. And again, this is growing from last year. This is because, again, there's additional active employees and each of them are expected to accrue an additional benefit. And so that directly leads to your actuarially determined contribution, which you can actually better see in this bottom graph. When you see normal cost year over year and your past service cost, you're going to say, but wait, you just said the normal cost is going up. Well, this normal cost component has three pieces actually. Your expected accrual, which is reduced by employee contributions. And then there's a component for administrative expenses that we expect to accrue in the next year. So you're paying all of those pieces off as the normal cost of doing business and having a pension plan. And so more of the change you see is in the past service cost, and that's because of that slight loss from additional employees and the gentleman receiving additional benefits. So we get to the bottom line summary, and this compares last year to this year, and you can see just side by side the changes. We're not proposing any assumption changes this year since you did reduce the interest rate last year, and you also updated your mortality table to the most current Pub 2010 mortality table. So there are no changes recommended to be made. This is effectively where we land, summarizing year over year. You're now amortizing over 14 years. So that's paying off the unfunded liability over a 14-year period. And then, as I mentioned, the expected expenses are slightly lower than last year, 88 going down to 32. So your bottom line is increasing from 907,506 to 967,790. And this is different from what we expected, we had actually expected your contribution to increase from the 907,506 to 937,000. So it's a $30,000 increase more than what we had expected.
Mm-hmm.
But overall, especially given how the market's been and COVID impacts that we don't know how they will play through, it's a pretty reasonable year of results.
Okay, good. Now you're going to review the town next, right?
Correct. I was just going to
Okay.
pause and ask if there were any questions on the police before we look at the town side.
No. Well, one thing about the police, at least for the next year or two, we're not expecting any retirees.
It would be surprising to see some retirees. They could retire early, but then they would receive a reduced benefit for retiring early.
Right.
It's also possible they might terminate and be due contributions in the future or a pension benefit in the future, but not likely to see a lot of retirees based on how they're distributed right now.
Mm-hmm. Okay. Are there any other questions? If not, we'll go on to the town part of it.
We're good, Ed.
We're good. Okay, why don't you pick up the town now?
All right. So town side is where we get a completely different story because the town side pension plan has been closed to new employees for a number of years. And so you can see every year your active population and your total population has been decreasing. This is how we end up with such different results between police and town side. So in this last year, you had 1 active employee terminate, 5 retired. And by terminate, I mean they left the town's employment and they are due a benefit in the future. So that's why it went from 13 to 14. And then you also had a number of retirees and beneficiaries pass away. You had 4 retirees pass away and 3 beneficiaries pass away. So significant decreases in your total population. And again, this is where it differs from the police side, where this is an older population. We do anticipate more deaths to occur. Scrolling down to dive into your active population, again, you can see how different it is from the police side. The concentration here is in the older ages and the longer years of service. This is a direct result of the plan being closed, but also people just aren't retiring as much. And we can look at your retiree population very similarly, except you can see their average annual benefits are significantly lower than on the police side. So we have 17,000 for your retirees and 13,000 for your beneficiaries. You might remember that was more like 40,000 on the police side. And your average age is 73. So this is why we're seeing more retiree deaths on the town side. Assets are very, very similar to what we saw on the police side. Same type of curve. You have similar types of investments, so very similar results. And so we see the exact same thing happening with your asset growth over time as well.
And here we're using the same 6 3/4.
Is 6.675, correct?
Right.
And so it's the exact same asset allocation, exact same information we just went over on the police side. So then we get to your bottom line results, your funded status. Your liability stayed very, very stable from last year to this year. One interesting thing that you may remember from last year is that an audit took place in this past year of your retiree data. One of the things we discovered last year was that there was a population of employees whose benefits were scheduled to be reduced once they reached their Social Security normal retirement age, but that wasn't always happening on time. And so last year's valuation, we reflected a slight increase in your liability because those benefits hadn't been reduced. But this year, an audit took place through a lot of great work on the town side, going through old data files, comparing notes, comparing all the benefits. And so this actually decreased your liability from last year to this year to the scale of $500,000 actually. So really great work on the town side to research the information and make sure that everyone is receiving the correct benefits that they are due.
Excellent. And I see the funding ratio for the town is in the 80s, which is good.
Yep, correct. And so you see the same type of improvement.
And that compares pretty favorably, I take it, to the general towns around.
Absolutely.
And the national average.
Absolutely.
Okay, good.
So this is where the even better news comes in. You've had a significant decrease in your actuarially determined contribution because of those efforts that reduce the liability, as well as the additional contributions that have been made to the plan. So this decreased your actuarially determined contribution by over $200,000.
250,000.
Mm-hmm. Yep.
Yeah, that's good.
So then we get to the final bottom line comparison year over year. Again, no changes being recommended here. And you can see that there was a significant decrease in your expected expenses. So that helped decrease your normal costs significantly, as well as the decrease in your past service costs because of the reduction in your liability from that research.
Yeah, I noticed there the net normal cost, 658 down to 462. Mm-hmm. That's what you're referring to, right? That savings there.
The normal cost is being reduced partially from your active employees retiring, so we're not expecting an additional accrual there. But then also there were significant expenses in the previous year that translate into expected expenses, and so that was reduced as well.
Okay, good. Is that a one-time thing, do you think?
It should be a one-time thing.
Okay. So then our contributions going forward, dropping from 1.3 to 1.1, that will be somewhat consistent going forward?
I would anticipate it staying more around the 1.1, not that you'll see $250,000 decreases every year.
No, so that should stay right around that figure going forward.
Hopefully, yes.
Okay.
Assuming that, crazy things don't start happening, but you should see a relatively stable contribution. We actually had expected for this year the contribution to be 1.426. So we expected a modest increase in it, and instead it was a significant decrease.
So that saves on the town budget side.
Correct.
We don't have to put in as much.
Correct.
Right.
Okay, very good. Very good. And I know Mike will get into it, but our return on our portfolios probably have helped some too.
Yes. I can't comment on what's happened since July 1st, since we don't monitor for the quarter, but definitely as the markets rebound, it helps significantly.
Right. Well, Mike will get into that with us. Yes. Hey, are there any questions on the town side? Does anyone have any further comments or observations?
I'm good, Ed.
Everyone's good? Okay.
All good here too. Yep.
Okay. So why don't we move on then? Thank you very much.
Thank you.
Now we'll get on to our performance review of our defined benefit plans. And I think we have, let's see, Mike here. Who's on next here?
Yep. Can everybody hear me?
Yeah, here he is, Mike Fort.
Yeah, so keep in mind that in the 60s and 70s, when these defined benefit plans really at the state and local level the interest rate environment back then, as some of you may remember, 10, 15, 16, 17% fixed income in the 70s. And that, if you kind of take a step back and keep things simple, you're matching up the assets with the liabilities. And when the fixed income market was as accommodating as it was, these plans were created. That all ended in the 90s, where all of a sudden, it's what's known as the equity risk premium. So if you think about equity risk premium relative to today, so if I gave you $1 million and you had an opportunity to go out and invest it, COVID has wreaked a lot of havoc in capital markets. Staying on this exact topic, and sort of an out of nowhere 100 basis point rate cut in fixed rates. So right now, a 1-year CD is paying 5 basis points. And you have to go out 2 years, 3 years to get 10 basis points. Just so we're all speaking the same language, 1% is 100 basis points. So the equity risk premium is the fact that if you have a defined benefit plan and you need to hit a target of 6%, well, there's no way you're going to achieve it in fixed income, right? So investors are forced to look elsewhere for return. Now, 2020 has been a mind-blowing year, right? So many crazy things have happened. And I'll just set the kind of the backdrop to where we are today before I get into performance. The S&P 500 since March 23rd, okay, is up 65%. So, this is my 25th year in the business. I've never seen 10,000 points disappear from the Dow Jones Industrial Average faster than the financial crisis of 08. But it was during the earlier part of the year when I talk about the 100 basis point interest rate cut, we had money markets break the buck. And if you understand what a money market is, a money market, right, is supposed to have an NAV of 1. And we had money markets, something that I would never thought I would see. It did happen in the financial crisis. And back then, you might remember it was Hank Paulson in front of Congress. He was on TV. He was the Steve Mnuchin of the time, talking about shooting a bazooka and how we need to support these markets. This go around, and maybe it was life lessons from the financial crisis, but Mnuchin would be on, in the morning before the markets open, saying that he's backing the money markets. Municipal bonds fell 7% in 1 week, right? So the Federal Reserve, since COVID, has thrown trillions of dollars at the issue, but they're still in a very $70 billion a month bond buying program, unlimited support against money market and short-term debt instruments. So yes, the markets have held up, but understand a lot of it is not necessarily by its own 2 feet. If you can go back to mid-year, right, when we were in lockdown, 60% of the United States was out of work. To put that in perspective, and just imagine what we've seen in 2020 with turning off an economy and then turning it on, throwing trillions of dollars at the problem. And by the way, all eyes are on the last go around of bailout money that's going to get sent out there. Notably, what's hanging it up is how much is for state and local communities. So, there was pretty high conviction 2 months ago that was coming. And here we are today with the election and everything that's happened. And right now, nobody really knows if that fourth stimulus COVID package is coming or what it's going to look like. Clearly, we are in a V-shaped recovery. Some of the economic numbers that came out in the last 60 days are mind-blowing. 336% increase in car sales. I mean, just numbers no one's ever seen before. But if you just picture the turning off and then the turning on, you have to take a step back and put it all into perspective. So setting that as the backdrop, right? If someone were sitting here and I would ask them, you tell me, what do you think the best performing asset class is, right? Is it international? Is it bonds? Is it really, what's the number one performing asset class? I don't think too many people would have the answer, which is growth, large cap growth. You guys were around in the late 90s, as was I, and I remember back in those days that, you know, everyone just wanted to own Yahoo, AOL, EMC, and Cisco. Right now, the S&P 500, 6 stocks represent 31% of that index. And we are being, you know, watching these large cap growth stocks just grow to the sky has been, you know, for those of us who have been around, we know that that can't last forever, and that you could possibly see my firm, Morgan Stanley, we are relatively optimistic about 2021. There's a number of things that have to happen. But we have high conviction of what we call a value rotation, that these nose bleeding growth stocks are going to have to come back down to earth, and that spiral on the growth end could get pretty ugly. And I'm not talking about Tesla, which is up almost 450%, 450% this year. Company that doesn't make money, that just got added to the S&P 500. There are plenty of stocks that have strong balance sheets, consistent dividend growth, top line numbers that are growing, and, you know, relatively cheap asset. In fact, the S&P 500 growth benchmark as of 9/30 is up 21%. Okay, so if you're all growth, you're killing it this year. The S&P value index is -11. That dispersion in my 25-year career, growth and value, have sort of alternating, sometimes value leads, sometimes growth leads. And in fact, when you look at the long-term numbers, the returns are pretty close. But it's just anything that has the, kind of like the .com days, is that these COVID stay-at-home stocks are just accelerating through the roof. I always tell clients or, pension boards, what's going to happen to these COVID stocks when the vaccines are out in full force and the therapeutics? I try to ignore politicians and listen to scientists. And the reality is, whether it be Pfizer, Moderna, Eli Lilly, there's a bunch more coming. And there is, God willing, going to be an end to COVID. And what's going to happen to those stay-at-home stocks that have, when you have companies selling 30, 40, 50, 60 times earnings, by the way, Tesla has a PE of 1,200, okay? When you have 30, 40 times expected earnings, the humility that may be dealt to these companies, is coming. So along the lines of that value rotation, we can look at, the plan in the last 12 months is up 6.31%. It's up 7% in November, which we're halfway through it. That's almost $2 million. Our large cap growth manager, ClearBridge, up 32%. The Vanguard Index, right, that's up 15%. We've also had some return, finally, from our international manager, Harding Loebner, up 16%. So all of those capitals. Now, keep in mind, the value managers, the mid cap and the small cap managers, and you know, you're looking at anywhere from you know breaking even to 2 or 3%. We do have our fixed income position, as you might remember, those who have been around, is all in short duration. Year to date, we have had positive 3.6% rate of return. You know, in hindsight, we probably were a little too early to move down the duration curve, but you know, it seems inevitable that at some point in time, you know, now they're talking 2022, maybe 2023, but we only have to go back 2.5 years from today, and we were getting almost 3% on 1-year CDs, right? We had money markets paying north of 2%. So it's really sort of a double-edged sword with the expectations of rate increases, which certainly for the rest of this year look like there's no chance of it coming. So taking a step back to the asset allocation, you know, we continually making the $171,000 monthly distributions on the town side, $61,000 of benefit payments per month on the police side. That, you know, the original asset allocation is, you know, probably looking really good as we head into 2021 when we see the growth rotation in the value, and that being short on the interest rate, when interest rates do and when interest rates start to increase, we'll be in a good spot to capture all that upside. So, you know, in summary, you know, you can see what happened in the first quarter to the pension plan, a 15% drop, which, you know, 15% drop, that scares the daylights everyone, but go back in time to that first quarter and how scary the beginning of COVID was, only to snap back in the second quarter up almost 13%. We are up 5.5% this quarter. So, you know, the longer we go back, and it goes back to Michelle's target of the asset class. I mean, since 2002, believe it or not, if we were 100% invested in the S&P 500, right, we would have done significantly better than 6.625, right? So the long-term projection of the assets is sometimes it's hard to understand that, but you know, I feel good heading into the rest of the year about where we are for, you know, the return assumptions to be met. So that's where we are from a portfolio construct standpoint, and there are no changes recommended at this time.
Yeah, that's one thing I was going to ask you. If looking at this market going back and going forward, if there was any asset allocation changes you wanted to make or recommend, and you're saying hold steady.
Correct.
And that goes for the police as well.
Same allocation. Yep.
Okay. And the firemen as well.
And LoSAP as well.
Yeah, the LoSAP. Okay. All righty. And I notice our contribution going in is, Bob, you can comment on that. I think it's pretty steady.
Yeah, I mean, we've been consistently putting in our contribution on a quarterly basis.
I think that's helped a little bit with the performance, but the point is we've always tried to put in more than 100%, as long as the budget would allow it, more than 100% of the required contribution. And that certainly helps us with the funding ratio, but also helps us, I believe, with the analysts, S&P and Fitch, when they come to rate the town, and it's helped to maintain AAA status.
Right.
They look at right away, so.
And right now, we're keeping enough money in reserve so we can make those payments out without having to sell anything.
Correct.
Yeah, and we still have a good cushion there. You're maintaining a pretty good operating cushion. Okay. Do I hear any comments, opening up for comments? Any other questions for Mike at this, or Bob at this point? On how we're doing?
So Mike.
None from me. Things look pretty good.
Okay. I think, Mike, it's a good report. Bob, one thing I want to ask you is on our debt, we're getting pretty good rates now in going out in our borrowings.
So back in July, the middle of July, when we bonded $20 million for the renovation of the two schools, the long-term rate, 20 million for 20 years, 1.255.
Well, that's great.
All right, then we also did a 20 million band short-term, which comes due this July, and we'll probably bond it, but that was 0.29%. Incredible. I mean, we did have, I think at one point we had 11 basis points, maybe 4 or 5 years ago, but
I know it's not on the agenda, but on our liability insurance, we're okay there. We got a good renewals on our liability.
yeah, right now, it looks like the lap and
Hello?
we run out of time.
No. Dion, did you mute us by accident?
Yes, you guys got muted, but you're back now.
Yeah, I think I did accidentally. I apologize.
Okay.
The liability, auto, and personal property will stay pretty much consistent, close to zero. The workers' comp with a small increase possibly, but we won't know that for sure until late winter, early spring, somewhere around there.
And our what do we call it? Our injury ratios are good. We're still doing all those classes and getting the extra points.
Right now, the classes are all, definitely that. The classes are all virtual. We've had a couple of cases, but just a few. We had a review yesterday. On the town side, we probably had 4 workers' comp.
At our last safety committee meeting, which we hadn't had in like 8 months, we only had 2 reports of injury.
Okay, 2 current ones that are currently operating.
There's more current ones, but there's only 2 new ones in the last, not 6 months, 9 months.
And on the Board of Ed side, there's just a handful there as well. So we're doing really well with that.
That's good. That's good. Here again, comparing us to other towns, we're holding our own.
Oh, I think so. I think if anything, with the 6.675%, I think we're ahead of a lot of the other towns. I think the state just brought theirs down to 7%, just did it, and we were there for a long time. So we're ahead of the curve on these things.
Great. Are there any other questions for Bob or Mike? Do I hear any other questions or any comments or anything to bring up?
I would say, a question to Mike. You talk about the growth.
that allocation, leaving it in growth at this point is fine until the next meeting when, I mean.
Yeah, so
the value won't kick in until maybe 6 months?
the risk is in those 6 stocks more than it's in the growth sector overall.
Mhm.
So the growth manager we have is what's known as growth at a reasonable price. So it's not time to bail on growth totally, but you got to be careful that you're not chasing these rainbows. So our manager has it's still okay it's why we diversify. When you diversify, you have the best performing asset class and the worst performing asset class and everything in between. And as the standard deviations of all those portfolios, right, we have that straight line efficient frontier. So it's not time to liquidate all the growth, but just be aware that the rotation is coming and make sure that your manager, isn't loaded up on those unicorn stocks.
Mm-hmm. Okay.
And he starts getting into value and the value and the small cap end that hasn't participated much.
Right.
Okay. All righty. So if I have no other questions, we'll move on to the next agenda point, which is really looking at our meeting schedule, consideration of the 2021 regular meeting schedule. If people have that in front of them, it was sent to everyone. So pull that out and you'll see the January 20th, 2021 is already approved. But we have coming up April 21st, July 21, November 17th, and January 19th, 22 for consideration. Do I have any input on that? Anyone that wants to make comments or changes?
Ed, the only thing I would like to speak to is the time. Right now we have a 7:30 meeting schedule. I mean, if COVID continues the way it is, maybe you want to do these meetings during the day. And if not, if we open up totally, then maybe move the 7:30 to 7 o'clock. Most of the town meetings are at 7. I think we're the only commission or committee that has a 7:30 meeting time. So that's up to the commission to decide. So.
Yeah, well, I would say certainly the January 20th meeting, we're probably still going to be in COVID. So getting that at 1 o'clock, if that's fine for everyone, we could do that. As far as April 21st, that's a question mark and going forward. But 7 o'clock, I would say, I see no reason why we can't make it 7 rather than 7:30. And the 1 o'clock would be good for the COVID and the Zoom meetings. Do I have any input on that? Anyone that has their opinion or anything different on that?
This is James. I'm fine staying flexible with daytime meetings for the time being, and 7 o'clock sounds good too.
Okay. So does anyone else have any input? Then what I would say is I'd like to see a motion that we approve the meetings with that 1 o'clock for the 20th one and 7 o'clock for the others out, or 1 o'clock if we're still in COVID. Do I have a motion for that?
Yep, motion.
So moved. Yeah, second.
Okay,
Then.
do I have a second?
I'll second that. Yep.
Yeah, so all in favor?
Aye.
Aye.
Aye. Any nays? Okay, so moved. From what I can see here,
I have a question. So
yes, go ahead.
I'll do the schedule up for you. So you'll do the January meeting for 1 o'clock, and then I'm going to set the schedule up for 7 p.m. for the rest of the meetings.
That's correct.
And then if you want to move it to 1 o'clock, then we can do it at that time. But the schedule
Correct.
will read 7.
Correct. The schedule for the 20th of January will be 1 o'clock on a Zoom meeting.
Yes.
And the ones after that probably will go to 7 o'clock on regular meetings, unless we're still in COVID on April 21st.
Okay.
And then that meeting would be 1 o'clock.
Mm-hmm.
Okay, so moved. So at this point, if no one has any other input or anything, I would ask for an adjournment. Do I have a motion to adjourn?
Motion to
So
adjourn.
Second,
Second.
all in favor?
Aye.
Aye. Any
Aye.
opposed? Okay, everyone, thank you very much.
Thank you.
Everybody have a great Thanksgiving.
Thank you. You too.
And
Okay.